Welcome back to the show. It has been a roller coaster of a week so far, and I'm going to show you how my portfolio has held up versus the recent market volatility, and also talk about how I plan to beat the market with this strategy. The FTSE 350 has fallen by around 2.27% this week, and I suspect this is due to the ongoing trade war between the US and China, and as the saying goes, when the US sneezes, the whole world catches a cold. We're very impacted by the US economy. And also the idea that Brexit is just around the corner and it's looking more likely that we will not have a trade deal. On a more positive note, Boohoo has actually been in the news again, but this time it's not modern day slavery allegations, and in fact it's about their subsidiary Pretty Little Thing. They're actually expanding their headquarters in the process, looking for 200 more employees and also increasing the headquarters size by 10,000 square feet. They've also made another acquisition of a factory that used to be owned by a car dealership. They paid $3 million for 2 acres or 27,000 square feet to make a state-of-the-art textiles factory in which they're going to continue producing their products. And honestly, it feels like this company is about to grow a lot. They've had so much growth that they have to keep building more offices because they've got so much products under management and therefore have to ship more. So it makes a lot of sense and it's a very positive sign for the company. Despite this, the share price has remained very stagnant, and in fact, at the start of the week it had rallied a lot, but now it is kind of just settled at around £2.55 per share, which hints to me that perhaps some funds are still selling, or perhaps they're still trying to shake the tree and hit stop losses of investors. However, the volatility hasn't been that huge, and since the news outlook is starting to look positive, it's very likely that once the volume starts to lower, that the share price will start to go up. Although I must stress that we should all be prepared to wait until at least September before seeing the share price go up any more, as it's very likely that it could remain stagnant around this area. And that's before seeing this stock really unleash true havoc. With this in mind, I actually bought more shares, and I've actually acquired 250 more shares, bringing my overall total up to 2,000 shares. An average cost of around 246.46 pence per share, and I'm very happy with this. And unless it drops out by more than 10%, I'm not going to be buying any more for the portfolio, as it currently takes up around 54% of my overall investments, and that's very high risk, and I want to now diversify away from it whilst this stock grows. However, in the future, it's looking very likely that if the share price continues to grow, it's still going to look like I have such a large amount in Boohoo. So this is the time where I'm going to sit down, invest in my other stocks and build those positions up. Boohoo is actually up 9% for the week, and I've gone from being minus £220 to up £171. Face masks as of July 24th are now required in shops and stores. However, they have the decision themselves of whether they will enforce it or not. And a UK leading supermarket, which I believe is 5th ranked in market share, Sainsbury's, actually posted that they would not enforce this law, and therefore said that customers are welcome whether they're wearing a face mask or not. And this has had some controversy around it because obviously some people don't like masks. They claim that the oxygen is reduced, but some people really believe by it and don't want to increase the risk of infection. It's an interesting move by this company, but I believe that perhaps their stock price will be more affected than their actual stores. But this does mean that people that don't want to wear masks are more inclined to go to Sainsbury's or use online retailers, in which case when looking for clothes to buy, Boohoo is in an amazing position, and also Games Workshop is in a great position as well, selling their royalties online and also being able to order their products online rather than going into hobbyist stores. If you've enjoyed the video so far, please drop me one of these for the YouTube algorithm. Have you noticed how much my portfolio has changed since I started investing in April? Initially, I looked for high yielding dividend stocks like Shell, GSK, Tractor Supply Company, Tesco, Britvic. All of these have decently high yields of around 4% or above. Yet I've sold out of them. And why is this? Which they had great high yields, but they typically had very low growth rates, or in GSK and Shell's behalf, they didn't grow it whatsoever in the last 5 years. And I think when first starting investing, we seek these higher yield stocks, as we feel that, wow, at a 12% yield, we could get excellent returns on our investment with this, and therefore it would be more reliable and we would make more money. However, what we don't realise when we first invest is that why is the yield so high in the first place? And it's very likely that it's due to a falling share price, or just simply not performing as well as their dividend growth. Whilst being interact with you guys, the viewers, I've actually been able to increase and develop my strategy so that it's more formulated and I can do better with it. I'm now more confident in my strategy than ever. And now I'm actually looking for stocks that can grow their dividends faster than the rest of them in the market, such as Ashtead Group. And you would expect, well, hang on, Ashtead Group only has a dividend yield of 1.5%. How have you still got a dividend growth portfolio? This doesn't make sense to me. And that would take around 66.6 years to get my return on investment just by dividends. And that would be very true, except that assumes that they just stop growing their dividend completely. And however, in the last 10 years, they've actually managed to grow it by a compound annual growth rate of 30%. This means that each and every year they've managed to grow the dividend by, on average, 30% every year. And in fact, back in 2013, if you'd have bought the stock then when it was yielding around 1.2%, you would have thought the same thing. Well, it could take 80, 90 years for this stock to regain your initial investment via dividends. However, they were paying 7.5 pence per share of a dividend back then. And now, in 2020, they pay 40.5 pence. Over the course of 7 years, your dividend income has multiplied by 5. And there's a lot of math, but it basically means that these stocks can give you great returns on your dividend. And so if I plan to hold these long term, which I do, and every stock I buy I do want to hold long term, it's just I find better ones, then if they stop growing with great capital appreciation, then the dividend growth is actually going to outspeed that of the capital appreciation, and therefore I'm going to be seeing greater amounts of income in my portfolio and therefore set me for retirement. And of all of the stocks I currently own, except Aviva, the lowest performing stock had actually performed and given you a return on investment of 190% over the last 5 years. And obviously there's the age-old saying where past performance isn't an indicator of what will happen in the future, and therefore you shouldn't use that as a basis on the investments. But it does tell you how much investors like the company. And in fact, a very good example of this would be looking at the pandemic crash in March. The companies that have recovered already or even reaching all-time highs, investor sentiment is extremely high. And this typically means that these investors want to buy and hold long term. Whereas you look at stocks like Shell, for instance, and they've barely recovered anywhere near. Obviously, they're very impacted by the whole price war and also the fact that oil prices are very low. But it does mean that investor sentiment is a lot lower as well. Funds sold out just because they are no longer providing that much needed income. And so I'm looking for these stocks that recover really well. And in the past, if they've recovered from a crash extremely well, then I'd like them in my portfolio. Which actually brings me on to my next point. And in fact, I've sold my second largest position in the portfolio. And it may bring a lot of controversy because I was very bullish on this stock and it was my biggest holding for a majority of the time of running this portfolio. And it was one of the stocks I've had since the start. And however, I still believe in this stock long term, and I do believe it to be one of the best house builders available for you to invest in. But I've decided that I don't want to be invested in house builders. I believe that yes, they can present you with great growth rates. There's a demand for housing at all times, and this island is only going to get more compact. And as the population increases, obviously we're going to need more houses. But I had the option to make a small amount of money and potentially break even, or the option of it potentially going downwards. And yes, obviously every investor has to be prepared for this, but I decided that since in 2007, from their peaks, it took them 10 years to recover, so until 2017 just to reach their all-time highs once again. Whilst yes, I do feel that if you're patient, this will be an excellent performer in your portfolio, there are other ways to invest in the property market, and I'd already got exposure to the construction market from Ashtead Group. And house builders really don't perform well in recessions, and this is potentially one of the biggest recessions of our lifetimes. And in fact, if you're interested, I actually hinted about this on my Twitter, where I don't spam you with my YouTube uploads, but rather try and engage you and discuss the stocks in the market. Twitter is Ozbourne Foreman, at Ozbourne Foreman, or there's a link in the description below. Whilst I still believe that Redrow is probably the best option for house builders, I feel that their dividend growth was very unsustainable despite being quite high in the last 5 years. They have fantastic balance sheets, and I still stand behind the fact that Redrow had decided to move away from London and build properties elsewhere, because the work from home trend is only going to become more popular, I believe. And in my time of investing with Redrow, they had consistently underperformed the market. And I'm talking about, until I sold them, they trailed the FTSE 250 by 14%. I was that far behind, meaning I was actually down on my investment. Although this is very likely a short-term impact and wouldn't constantly outperform or consistently outperform or underperform the FTSE 250, I do feel that this isn't a stock I want to be invested in because investor sentiment seems to be too low. And it actually taught me a bit about valuations of a company, which I'll speak about in a bit. But this doesn't mean I won't be invested in the housing market, however, as I'm still very interested in this sector. However, I'm going to be looking at more stocks like Rightmove, but I feel that valuations are a bit too high at the moment and therefore will be waiting before investing into this one. And I'm happy to miss out on some potential gains whilst waiting to find a good time to jump in, as I've already reinvested the money from Redrow elsewhere. And I'd sold it in 2 chunks, 150 shares, giving me around £600 into Boohoo, and the other stock where I invested the rest of it, I will tell you at the end of the video. Right now, 60% of you watching this video aren't subscribed, so if you're interested in my stock journey, my stock picks, and the stock analysis that I could bring for you, please consider subscribing, as after all, it is free. Thank you. Most UK YouTubers would have already mentioned about the recent news regarding Robinhood. Robinhood is a US investing brokerage in which they had planned to expand into the UK and potentially take some of the market share from more of the traditional brokers like Hargreaves Lansdown and AJ Bell, and also take control of the challenger brokers such as Trading 212 and Freetrade. However, they had actually decided to scrap the launch. And this isn't the first time they've done it. They'd scrapped their launch in 2015 in Australia as well. And I very much agree with the decision that they had chosen, as I feel that they really need to focus on their own economic area, the US, because they had an outage on one of the most popular trading days of the year, February 28th. However, I do think this is quite negative for investors in the UK because it means that as our brokerages are quite comfortable, they really aren't trying to innovate that much. Trading 212 has brought out pies, but that's not innovation, that's plagiarism from M1 Finance. Whilst yes, they are adding some new stocks each week, that's not really doing much. I really couldn't care much for a stock that's freshly IPO'd in the US that is a cannabis stock. Maybe you're different on this, but I feel that whilst it's a nice incentive, they really could be working on more important things. And so I'm a little bit disappointed by Robinhood's withdrawal from the UK, as companies or traditional brokers like Hargreaves Lansdown are likely going to continue with their absurdly high fees for pretty much no reason other than to make money from you. When starting your investment journey, you'll typically be looking for stocks that are high value. And I remember when I first started, I was very interested in stocks like William Hill, Aston Martin. These stocks had lost such a significant amount of their share price that I thought, wow, if I bought in at like 40p per share, well, there's only really upside potential and I could make loads of money. Yeah, this isn't really what you should be doing. And what I've learned actually is that whilst I do look at price to earnings ratios, price to book ratios, price to earnings growth ratios, I now no longer use them to evaluate the price of a company, but rather just use them as indicators. And I use them as indicators of investor sentiment. And now typically, I will look for stocks that have a higher price to earnings ratio than that of their industry, as it means that the investors in these stocks believe that this stock will continue to outperform and they're happy to buy at more of a premium. It's a very momentum-based strategy, but therefore I do think that my strategy has adapted to this, as whilst yes, value stocks are a great opportunity, and stocks like Aviva, Redrow, right, they have a lot of potential. But you've got to remember that it's not going to happen overnight. They're not going to suddenly stop trading at a 5 times price to earnings ratio and suddenly be at a 30 times price to earnings ratio. This won't matter to you if you hold extremely long term. And it's very likely that you will outperform, likely me, in the long term if you've bought a value stock that becomes and traded at a more of a premium in the future. I plan to invest more in these companies with a higher premium so that when they stop appreciating so much in capital price, I can then rely on their dividend growth to outperform it and provide me with a steady, safe income source in the future. Funny enough, none of my stocks that I own were in the top 50 risers or the top 50 fallers of the FTSE 350. And that's despite boasting a volatility of 1.429 in my portfolio, basically meaning if the market drops by 10%, my portfolio will drop by around 14.29%. However, with that in mind, many of my stocks have slumped this week, such as Aviva, which has dropped by around 3% this week, and I'm actually going to keep holding until August 6th, which is where they will announce their strategy, what their plans are with the dividend, and whether they will be splitting the company. Should I sell the stock on that date because I don't agree with what they plan to do? I'm likely going to reinvest it, and it may be the last stock I sell for a long time, and then hopefully it'll be more of a long-term portfolio, as I am very satisfied with all of my positions, and will then likely have a consistent portfolio where I can keep averaging in. I currently own around 500 shares of Aviva, and I've decided that if they decide to suspend their dividend or break up the company in a way I don't agree with, then I'm going to sell out. I'm going to reinvest 75% of that into another financial company, something like London Stock Exchanges. Their dividend growth is fantastic despite their high price to earnings ratio. And then the other 25% will likely be going and reinvested into other positions in the portfolio, one being Games Workshop or some of my tech positions, which I'll talk about. As I've recently found that the technology sector is a sector I understand best, I can largely attribute this to the fact that I've grown up around technology. I mean, there's so much technology in this room right now that technology is certainly one of my strong spots, and therefore I feel that I enjoy it more, and I'm going to put more time into researching these technology companies, and therefore I would like to have a larger proportion in it. Halma is one of these technology companies that I own, and hopefully in the future or by the end of the year I'd like to have around 10% of my portfolio in Halma, and I believe it's an excellent, consistent, reliable dividend hold that has an amazing track record of something like 40 years of dividend growth. Halma has only fallen by around 1% this week, and I've managed to buy 5 more shares, whilst the current position only has around an equity of around £250. I did buy into a new stock this week called Softcat. They're an IT infrastructure business located in the UK, and they provide IT solutions for businesses that are looking to upgrade and rely more upon technology. And I think with the way the future's going, a lot of businesses, especially with this pandemic crisis, will be looking towards upgrading their infrastructure and making it mainly cloud or online based so that they're able to work more efficiently and at longer distances. And this also follows my goal of having a 30% tech allocation in my portfolio. Halma will make up 10%. Hopefully this stock will make up another 10%. And then there'll be one more stock that I'll likely be adding in the next year or so, which would make the next 10%. And this is because I believe that technology has been the most resilient sector in this crisis. And yes, I do understand that different sectors are hit in each different recession. But so far from what I've seen, other than the dot-com bubble where they were trading at ridiculous valuations, I feel that technology is extremely resilient and can continue to grow even in times of uncertainty like a black swan pandemic event. Whilst I currently own 2 whole shares, I do plan to build this position, and by the end of the year I'd like to have 10% and then take the opportunities to average down on the way. The position I actually added most to this week was Games Workshop, one of my favourite stocks in the portfolio, but at the time I didn't have much on it. I've bought an additional 19 shares, and the average price per share was around 77 to now £81.6 per share. And I remain extremely bullish, and the results are going to be released on Tuesday the 28th of July. And so it's sort of a play to get in whilst it's cheap. And if I were to look in the last 5 days, I managed to get in at the lowest possible price, and I wasn't even awake for it. Mad. And I feel that during recessions, this stock will perform very well. It is a niche hobby stock. And I know that during a recession, I'm going to still put money into my hobbies. For example, if I was addicted to Yu-Gi-Oh cards or Pokemon cards, I would likely still be paying more and buying more. These companies are the ones that will benefit most during recessions, as they still have that dedicated loyal base. And it's not like people are suddenly like, no, you know what, I'm going to cut back on my hobbies. It's not what you do. You want to enjoy it. And during times of uncertainty, this company will do amazingly. Overall, the portfolio is up around 3% this week, which is quite impressive, seeing as the FTSE 350 has dropped by 2.2%. However, this is mainly held up by the fact that I own Boohoo and that they've started to rally. The general market's decreased. I've gained around 1 to 2% this week. I plan to continue averaging £125 into my positions each and every week. And at this time, I'm going to continue building up my cash position outside of the portfolio so that I can take advantage of any crashes in the future or corrections. And then hopefully reach my goal of 100,000 by 2023, which will really push me to the limit of both my ISA deposits and my performance of stock picking in the future. If I don't reach it, then I'll be disappointed, but at least I've tried, right? Make sure to stay tuned, because at Tuesday on 4 p.m, I'm going to be releasing my National Grid stock analysis. Thank you for watching. This is the Ozbourne Foreman Show. Have a great day.